On the Public Service Commission, we are here today conducting interviews as to securitization as requested by the Duke Energy Carolinas Company. Gentlemen, I noticed earlier when we went through the opening statements that you were both present in
Yes,
the
I think
room.
you can waive that.
Would you like to hear them again, or are you satisfied to go forward?
We're satisfied to go forward.
All right.
Yes.
Well, I'm going to turn it over to you then.
But good afternoon, ladies and gentlemen. It's an honor and a pleasure to be back in front of you to be able to present our credentials specifically related to the qualified independent third party as amended by recent legislation. Because this is a transparent and full process, I'm going to go over some things about my firm and everything that you already probably know. But since this is another process, we're going to repeat some things. And I'm not doing it to bore you, but to make sure the record is fully and complete, and there is a new commissioner as well. Saber Partners was founded 25 years ago by former utility, legal, banking, and capital markets executives that had worked together. This is our 25th anniversary. We're an independent private firm that really takes interest, take assignments in the public interest. And we specialize in the power industry and regulation because that's basically where our background has been for the 30 or 40 years we've all been working. We're not a broker-dealer or underwriter, and that's very important. And I think you've heard it from different sides, sometimes that it is important and other times that it isn't important. But we think it is important that we do not have any conflicts of interest. We have no sales, trading, swaps with Duke bonds or any other securities. We don't participate in underwriting syndicates, again. And we're not involved with investors who may purchase the bonds. Some people may think it's important to be involved with investors, but then you have to understand the dynamics of a firm, compensation, income, and other things that have all effects. And we have been a thought leader on utility securitizations. What I mean by that is we actually pioneered the use of certifications 25 years ago in Texas. So we're intimately familiar for decades with SEC-registered corporate and utility bonds. We know that you've heard a lot of talk about the municipal bond market, or people will say government-sponsored or something. It's a very different market than the corporate and investor-owned utility market. EEI and the American Public Power Association don't work together a lot because there's different interests and such. And the investors are often very different. Sometimes there's overlap when they sell taxable debt, but not the majority of those are tax exempt debt. So SEC registered corporate bonds is where we come from. Now we bring what we think is the right people to evaluate and provide you the information and comfort for you to make the decision. We have, and I believe he's on the phone, Brian Maher, who's a former Exxon Assistant Treasurer for Capital Markets and External Finance. Hyman Schoenblum, who's a former Treasurer of Consolidated Edison in New York. Paul Southern, who was an Assistant Treasurer in Florida. Barry Abramson, an equity analyst. Steve Heller, a financial analyst and structurer from investment banks of these types of deals. Becky Klein, who is the former chair of the Texas Commission, actually when certifications first were being used. But I also want to highlight two additions that have come to Saber since our last assignment with you. One is Ed Fitzgerald. Ed Fitzgerald and I have worked together and known each other for about 35, 40 years. The last 30 years he's been working he was the head of the structured investments for New York Life, one of the largest investors in the marketplace, life insurance companies. He's joined us and has this particular insight in terms of the investor base and contacts and buyer base. And to my left is John Robert Bob Hinton. He's the former economist from the North Carolina Utility Commission public staff, who was actually a member of the Duke Bond Advisory Team on 2021 on the North Carolina transaction, and can give you his personal views and perspectives on that. And that which we all think bolsters ours. Our methodology and expertise is documented, fully transparent through the multiple publications that we've come out. There's no secret sauce in terms of exactly how our approach is. We go into great detail. We've published for NARUC at the National Regulatory Research Institute. We just published in Nature Energy a peer-reviewed analysis of pricing and use of these types of bonds. And we have other publications in terms of our methodology, discount rates, and how to determine success in the capital markets. So it's there. It's just not an oral presentation. It's not a flip book. You see it, and it's documented. We're very proud of what we're right now. Our current assignment is that we are representing and advising 8 governors: Colorado, New Mexico, North Carolina, Illinois, Massachusetts, Michigan, New York, and California, in addition to the NARUC and NSUCA, who have passed resolutions in support of these 8 governors in their interaction with the SEC on this very important issue of the classification of the bonds and what that does to affordability and electricity rates. We have very detailed information. There's some things in the back. I don't think we're going to get that to today, but that's something that may come up and we may need to brief you on through. We understand Governor McMaster was interested in potentially signing on to this letter. A member from ORS, I think Mr. Edmond, spoke with the governor's office in Colorado on some things, but decided to wait and see how the governor's this dialogue comes out. It's at a very critical stage, and we will be able to update you through the document management system. And our approach, we think, is very straightforward, and it's aligned with what we think a qualified independent third party should do.
Trust, but verify. It's still play, but cut the cards. It's still watch closely, and don't be afraid to see what you see.
And I think that's our philosophy too. Trust but verify, cut the cards first, and be open and honest and see what you see. And the 3 key phases in the legislation here, I think, are important in terms of where we go forward. First phase is obviously the financing order process. You haven't issued a financing order, and in our RFP there was a duty to inquire, and we provided a number of questions which we think should be addressed potentially in the financing order, and we're happy to have any of the materials that we filed with you to be made public and provided. Nothing that we provided you we mark confidential or confidential and cannot be released. In fact, we would like the information and analysis of opinions and certifications to be released because I think that's an important discussion point. The legislation says that the qualified independent third party is to provide information to for you to make a decision as to whether it has achieved the lowest charges, not just the interest rate on the bond, it's the charges. So that's all the other costs associated with the transaction as well that go into those charges, which is a distinction. And we also saw that, phase 2 is then the pre-issuance process, structuring, marketing, and pricing. As we look at the current financing order, Duke has proposed that you approve various things on estimates and giving them a great deal of flexibility then to make all of the final decisions subject then to this review process. Well, you can do that. You could delegate all the authority to them, but you may want to make adjustments if there are material issues that come up during the process that would affect the charges. Not just little things, but if it's something material, like the ABS corporate issue and a discussion with the SEC or something that NARUC has done, or something that has happened in the market, then we should be able to bring that to you in the document management system have a discussion. People can brief. We can also follow the confidentiality rules if there is issues related to that. And then finally is the issuance advice letter. And that, there's some ambiguity in what we've seen in the proposals of whether the QITP is simply an observer throughout the process, but can't really he has the ability to talk to the parties, but we don't know whether Duke will say that that means he can't talk to market participants. And whether you're just supposed to be like a data request, just reviewing numbers are in a letter. So what numbers in that letter might be important, and we have ideas about a more detailed issuance advice letter process that will give us more dynamic information. Many of the issuance advice letters are simply pro forma, lots of schedules about rates and everything, but nothing that gets to that issue of the lowest charges. So we just see for each phase defined in the role, what's our duty? Will people accept the fiduciary duty and professional standards, because those will affect the effort and the cost? We gave you in our work plan, attachment A, a very detailed memorandum with a lot of exhibits, but that was an example of the thoroughness of our work and our willingness to document, not just shoot from the hip at meetings like this and say this and that, but put it in writing, see it, people can ask questions, go back and forth, make a decision. Effort will affect the quality of the certification. The quality of the certification will affect the comfort that you will have that it may be done. We put an analogy there about, buying $1 million house, and, the seller tells you, I've got an inspection that says the house is great shape. It's the best price you could ever get. Go buy it. And should you just accept that, assume that that inspection report is correct? Or do you hire your own inspector? And then if you hire your own inspector, does that inspector say, are you calling me a liar? Or, you can see the pictures from the house and you say, well, I'd like to get in and actually look at the house. Well, no, that'll take too much time. Well, there is a process in terms of what you're going to do, your due diligence. You can assume that they did this and that. You can assume that the pictures of that. And then you could say, what we think is a qualification, if you ever see, as you see in the analysis, when you say something without independent investigation. When you see without independent investigation, that means I didn't look. I didn't do my own work. But if you look at the statute, it talks about independently participating in the pre-issuance process. It talks about providing additional information. So we think it's better, but you can say other commissions were comfortable with that pro forma piece of paper. You could do that. It'll be lower cost. But if you want a higher degree of certainty, you're going to have the professional standards associated with fairness opinions and other things. We have actually done 13 of these. We're sort of like the New York Yankees of certifications. We've done them since 2001. And the dockets that we have done we'll go through have had all sorts of different cases associated, but they basically can provide a report to you and give you confidence. And what I want to show now is that in the last certification we did for the Florida Public Service Commission, with the full support of the commission and adherence to best practices, we think the following can be the same for.
Okay, good morning, and thank you for joining us here today. This meeting is called to order for the petition for issuance of the Nuclear Asset Recovery Financing Order by Duke Energy.
So this was as I said, a very successful effort. A lot of people were involved. And we would have not had this result, though, without the tireless efforts of our financial consultant, Saber Partners, and Joe Fichera in particular.
The OPC saved its best thanks for the Commission's advisor, Saber Partners, and especially Joe Fichera, and the Commission's bond counsel, Dean Criddle, who brought impressive expertise, experience, and discipline to the transaction, and without question were instrumental in saving many millions of dollars for the customers in current and future costs. Through their dogged and expert advocacy to achieve the optimum and lowest cost for customers at the outset.
We support Duke's issuance advice letter. We support Saber's opinion letter. We are profoundly grateful for the $684 million of additional savings over and above what you already approved in the 2013 global settlement. And I'm profoundly impressed, the Federation is profoundly impressed with and by all the work that went into this, and even more so by the result. This is just really, really great. I'm going to close with 3 words. Wow, and thank you.
That's great.
Already been made. But I also would like to acknowledge the foresight of those who worked on the legislation in providing the resources and the direction for the Commission to be able to hire outside bond counsel and outside financial advisors. I do believe that was a very important part of the process and an important part of the success of the result, working closely, of course, with our staff and all of the involved parties. This is truly a good news story, and I hope that that good news gets out that although it is a complex financial transaction, it is an innovative financing mechanism to address a very unique situation. And I do believe that the result that we have before us is consistent with the statutory objectives, that the lowest charges consistent with the prevailing market conditions have been achieved, and that we were also able to achieve the greatest possible consumer protections. Lots of moving.
And we get positive results. Positive results. So seeing that we do not need to have a motion, and we don't need any further discussion, if no one has any further discussion, a big thank you again in closing, and this meeting is adjourned.
The reason we ask you to believe us is that we've done it, and we've done it before. And in fact, Texas had in 2000, 25 years ago, going back, had a similar statute talking about providing a net benefits, qualified, and then structuring and pricing. Didn't have the word marketing, but structuring and pricing with the lowest transition charges consistent with market conditions in the financing order. And here, the former chairman and commissioners who were at that time talked about our abilities and support of providing this, because they were the ones to initiate asking us as advisors to provide a certification. It was uncharted territory at that time. And how to do that and how to go forward was very difficult. But what it did, in the information that was provided, you can see that over the course of the pricings that we did versus the other pricings in the market were substantially below. Not all of them were, but as you can see, that the trend line and in terms of the maturities and such, they saved money and they consistently beat others in the market. When you're negotiating with folks, people are going to be talking to you about, well, look at those other transactions. We would always say, well, that's nice information, but that's yesterday's transaction. We're talking about today's transaction. And that's how we would drive tighter spreads in the negotiation. Some of, for the record, our other clients in Florida, West Virginia talked about our abilities to develop a plan, reduce the overall cost and interest rate. In North Carolina, Chris Ayers, where we work, believes that we are a great better advisors to commissions than we are to interveners, which I do agree with them. In which that's where but we've worked on both sides. So where we say to you, we wanted to point out some of the key issues. One, will the contract say that we are a fiduciary and that we have to act in your best interest? That's important. Some people will or not do it, have that role. What's the form? One of the things, as you will see in our work plan, you do fairness opinions or you do other, you're not supposed to rely on information from a source that's conflicted, who has a financial interest in things. Law firms cannot rely upon other firms that have interest. They have to do independent due diligence. But all that could be, in a way, if your contract or your form of certification says that's allowed, then if that's what you're accepting, that's what you're accepting. But we think that's something you should be knowingly going into the process. What are the standards? Fairness opinions, there's a lot of court cases and everything in Delaware about when a board of directors who has a fiduciary duty to their shareholders is involved in a financial transaction, they need to get an opinion about what they're about to do. That opinion has certain standards of due diligence associated with that. Are they incorporated here, or are we looking not to that? That's an open question. Are we at the negotiating table, or are we outside the room waiting for them to come to the results and say, guess what, it was the best deal that we could get, here's the numbers. And it's not a quantity. The legislation talks about the QITP making judgments. So that's making opinions. It's not just looking at data. And we know this is important because we looked at a contract in Missouri where the contractor is going to submit a same thing, whether the structure, marketing, and pricing result in the lowest charge consistent with market conditions. However, it inserted a proviso, provided that that letter would not constitute and should not be construed a fairness opinion, as that term is used in court. Well, why would you put that in there? Is that a benefit to the ratepayer, or is that a benefit to the certifier? It's a benefit to the certifier. Reliance. The contractor can rely on any certificate from any third party without independent investigation or notification. Now think about that. If you're allowed to provide a certificate, if the underwriters have to provide a certificate and the utility provides a certificate, and your contract says you may rely on that without independent investigation, you get into a circular motion. You're now relying on other people's certificates by contract without any responsibility. So, devil in the details. There's a whole body, the 40-page memorandum we sent to you. We'd love to have it made public and part of the record and let people comment on it. The challenges for a South Carolina paper is in 2023, when you've heard this ABS, the bankers were saying these are cheap AAA bonds. They published this. 40 basis points wide, the AA. That's 40 basis points. That's a lot of ratepayer money on the table. It's not just a couple of basis points. And you say, well, that was a year, the market's efficient, people go. Well, here is an article that appeared on March 15th, 2025. The headline is Buy-Siders Finding Yield in Utilities. I'm quoting. And by the way, I don't even subscribe to this. They don't work for me. I'm reporting to you about the market. They say utility fee bonds are producing outsized yields for investors. They're hungry for 15 to 20 years, paper like here, seeking fatter returns, but still getting AAA rates. buy-side base for such securities extremely concentrated. And then there's a reference to the governor's efforts. So you've heard information that there's plenty of investors that buy these bonds. Absolutely. But they're getting outsized yields. They're not saying, and there's also discussion in here in this article, I think, that a recent transaction was done for Clico in Louisiana that was priced like a single A subprime auto bond. Just got to think about that. Remember the financial crisis? And subprime means the worst creditors. An auto bond, which is a car, which is not an electric bill, which is not, and you're pricing similar to a single A subprime auto bond in the asset market, something is wrong. We think so, and we think it'd be, and I often heard people go, it's the market. That's the market. The market is this, market's that. But you can, and my colleagues will join it, you can influence the market. And you can see here in this, if I can do a pointer, to the far left, you'll see is Barclays in the Duke transaction we showed. That green line is AAA corporate bonds. And when we achieved, and these are looking at all of the credit spreads associated with every deal done from 2016 to 2025 that had 20-year maturities, which is similar to the bonds that is being proposed here. And you can see the red line are what are known as BBB securities. They're weaker credits. And then so we see in 2016, we're right near and on top of that AAA line. And then by 2020, we're Southern California, they're there too. And then it starts to drift away. And it's almost like those charts where you see somebody might know that something's going on. Because all of a sudden, out of the blue, Bloomberg reclassified the securities from corporate to ABS with no substantive reason other than some of their investors complained. A class action lawsuit was then filed against them about a year or 2 years later. And then the SEC came out with a statement that was more confusing. But you can see that the spreads became more associated with BBB, weaker credits, than AAA. Now, why is that? Is the market just a market? Everything's efficient? Well, this is not. These bonds are not traded in an exchange. There's no full transparency associated with them. And one of the reasons that you have a qualified independent third party is to try to pull back at that cloak of them saying, yeah, this is what my investor told me. This is it. These are the only people and such, and bring more competition to the process. So we think that Saber Partners, as the RFP says, is the best value, most advantageous for the South Carolina Public Service Commission to hire. And we're grateful for the comments of our previous clients that support that with that. And we, rather than there's other slides going into some more granular stuff. If you want to get to that, we can do that. But I've spoken a lot and open up for your questions and my colleagues' perspectives.
Thank you, Mr. Fichera. Any commissioner questions? None? Commissioner Williams.
I'm searching for your name. Because
Bob-
as long
Bob-
as you're sitting there.
Bob Hinton.
Bob, yes.
Hinton,
Yes, ma'am.
would you like to add anything from your perspective?
Yes, I've been in the staff for almost 40 years, and so I've seen a lot and testified before the North Carolina Utilities Commission well over 30 times. For a host of finance and investment and planning and electric utility industry and a host of things. Mr. Fichera and the Saber team testified and helped the commission with a solid financing order to start the process. Now we had to implement, issue the bond, do the structuring, marketing, pricing. A director came to me and asked me, well, I know you weren't intrinsically involved in his testimony, but would you take over now? My heart sunk. I was asked to do something I wasn't really prepared to do. I took that role and I tried to do the best I could as consumer advocates. That's what the public staff is, as your ORS is the same. And but I didn't have the background, and it became so evident that I didn't have the background that the Saber team offered. And I wished I could have pulled them out of my pocket on numerous times when I was a member of the BAT team. I can't go into the details of the BAT conversation because obviously they're confidential, but I can say this. You can look at my letter. It's not a certification letter because I wouldn't let my lawyer call it that. It's what's called a letter of, I'll say, support. I filed it on November 18, 2021 for the public staff. I was the face. I wrote that letter. I used the words, the public staff believes that the process will likely result in the lowest storm recovery charges. Now, trust me, I struggled with that sentence. I struggled with will likely. I mean, I could have said probably, but I said will likely. I did not clarify what will likely really meant. I said will likely. The point was, I was always in the BAT team feeling inadequate. Now, you all have made decisions over the past years of the commission, just like North Carolina, just as I would testify and make recommendations. There's a level of confidence. That's a word we've used a lot today. You need a high level of confidence to ensure the consumer is well served. I came to the conclusion, and in association with Saber Partners ever since, that they are the team you want on your side, bar none. They have no conflicts. I think that's an important thing that Joe has talked about. And I think the essence of their knowledge. I mean, these people of the Treasury, when I was first with the staff, one of these men I used to read about in Merrill Lynch Bond Roundup. And I go, wow. And as a young analyst, when I was only 25 at that time, I was amazed of their knowledge of the bond market. Because you know the bond market is different than equities. We can all be an equity analyst, but we can't be a bond analyst overnight. But they had that knowledge, and they bring that to the table today. So I want to urge you, for that level of confidence that I lacked, I urge you to hire this team as your advisor.
I know if you would like to talk to our other people on the bench, Brian Maher from Exxon in terms of.
Yeah, I could say, if this is Brian, can you hear me? I could say a few words. I've been retired from Exxon for quite a few years now. I spent 35 years in finance and done billions of dollars of financing and complex financial transactions. And the reason I decided to sign on as a financial advisor for some of these transactions with Joe is because he did some really good work for Exxon, even when he was a banker. He was willing to stand up to his bosses who just wanted to get a deal done and say, no, wait, the client doesn't really want that, doesn't need that. And you don't always get that from bankers. So he has a level of integrity that you wouldn't normally have found in the banking institutions. And that's why he doesn't do it anymore. So I think that the key thing, though, is that he's a tireless worker. And I mean, you can hardly believe how much he cares about the ratepayer. I mean, we've been hearing this for 20 years now, and it's absolutely true. He's as interested in the ratepayer as the commission is, and that's quite a bit. And and look at the other parties in the transaction. I mean, Duke's a great company, but are they really interested in the ratepayer's best interests in this transaction, or do they want to get their money and move on to something else? Probably both, but they're split because they don't have the same need to satisfy the ratepayers that you and Joe Fichera would have. And then you look at the investment bankers, the underwriters, and it's way worse. Duke would be a hero compared to them. I mean, they want to get as many transactions done in as much of a cookie cutter way as they possibly can. And I saw this at Exxon. I mean, they'd be coming in and offering me transactions that had nothing to do with what Exxon wanted or needed. And so when they see this transaction, you've got to take into consideration that these investment bankers have investor clients and they have issuing clients. And they're trying to balance to serve both of them. So they would like their investor clients to get good rates, and then they also would like their issuing clients to, get good rates on the downside, offer lower interest costs. But, you can't exactly have it both ways. And I think you will see that the trend, and unfortunately, that what's been happening to securitization bonds has not been our friend recently. There are ways to use techniques and keep pressure on the bankers. There are ways to bring down the spreads over treasuries, and Saber has been able to do that in the past, and they can still do it. And some of them are technical. Some of them you get into the offering day, and you sit there next to the bankers, and when they proudly say that we're 4 times oversubscribed, then you say, okay, well, now I guess the rate we're offering is too high. Let's go back and get 2 times oversubscribed and see how well the ratepayer can do. That's one thing. The other thing is and this is the last thing I'll say, in the actual offering material, you would like it as plain English as possible so it doesn't look very esoteric, because it really isn't all that esoteric. And you also want to make sure that you're not afraid of something like the SEC staff when they make a proclamation. I mean, when we were at Exxon, we would submit what we believed was right, expecting the SEC staff would come back to us and say, well, we don't necessarily agree. That's what they're supposed to do, because that's why they're the SEC staff, right? But that doesn't mean you take everything they say and cave into it. And that's exactly what's been happening lately. And that's why these governors who really do want to do well for the ratepayers, these governors are fighting to get asset-backed securities unrelated from securitizations and get securitizations back where they belong, closer to AAA corporates, because these are excellent high-class securities with the state guarantee and the commitments. This is a fantastic security. And so this is my last thing. I think we all have to work, and you will be doing that as hard as possible to make sure your ratepayer gets the best possible deal.
Thank you. I appreciate the answers, gentlemen.
I don't know, Ed Fitzgerald, who has joined, you haven't met before, I would like to just ask, since he was an investor, might give just a few moments of conversation about, that you were on the buy side enjoying some of those juicy yields, but also willing to negotiate when we wanted to get on top of Treasury corporates. Maybe just a couple minutes of your perspective. He's joining our team as more depth for these types of certifications.
Thanks, Joe. Yes. Historically, we've seen utility recovery bonds trade in a very wide range as compared to AAA rated corporate bonds. I highlight the range there because, it can be as tight as 10 to 20 basis points and as wide as, 75 to 100. Some of that may be due to market conditions at a particular time. Others may be due to the size or the first time nature of an issuer coming to market, which I would say, and I think the Saber team would agree, if a deal price is very wide as a first time issuer, that the bank probably could have done a better job explaining the strengths of the program and the benefits of investing, benefits to the ratepayers and the strength of the bonds to the investor base so they can drive tighter pricing. To go to a point that Brian made, in many instances, dealers will get transactions well oversubscribed, but won't tighten spreads dramatically thereafter. Maybe they'll come in 5 or 10 basis points, they'll get a few players to drop, maybe not, and then they'll allocate. In some instances, we've seen where an issuer takes a hard line and they say, well, you're 12 times oversubscribed. Tighten the pricing 25 basis points. tighten in more. Let's see what happens. Who drops out? In those cases, you may find that there's substantial savings still left on the table in the normal syndication process that occurs. So that's something worth, thinking about how the commission would like the underwriters to approach marketing. As was mentioned before, they do have clients on both sides, and you want the clients, to evaluate the transaction and participate in it. So, there's a balancing act that dealers have to walk between getting the absolute lowest price and also ensuring that their investor-based clients are rewarded for the time and effort that they put in the ability to purchase some securities. And that's the fulcrum, I think, that a lot of players in the market, maybe don't use to their advantage as much as they possibly could. And what I mean by that is citing the case where an issuer came in and significantly tightened the pricing and had numerous parties drop. In my experience, there are times when these bonds are traded very cheaply and are just, really attractive instruments. And, parties come out of the woodwork to participate in them and they don't get priced out of the deal. Other times when transactions tighten dramatically, you may see people drop. So, don't underestimate the impact of the syndication process, the involvement of the treasurers of the corporations and or lead parties here to drive that pricing in to meet your standards of getting the lowest price possible for your consumer base. One last comment on securities. Securities, they are not that complicated. People make them sound complicated, but they're really not. And they have a tremendous track record in terms of performance relative to other securities. And further, they have a reliance on the ongoing production and distribution and consumption of electricity in the ratepayer base, right? Or the geographic locale where the receivables, in essence, are being securitized, right? Or the future payment flows are being securitized. So I think that also that does point out that there is more of a corporate, involvement here than you might find in a typical securitization where someone originates automobile loans, packages to get them together, and sells them. Once those loans are sold to the marketplace, then the performance is based on collecting and distributing payments. That's very different than a ratepayer obligation or a recovery bond, where the corporation is still has to either procure or generate the electricity and move it there. And this also for a very long period of time. So the mechanisms built into the securities, most, especially the true up, really provide a strong foundation for the securities and have led to their great track record and performance. But the reason I bring up the corporate bonds is it is a larger market, and getting utility players, people that buy utility corporate bonds into the book could be a positive, because these bonds will look cheap to many other things in the very highly rated, high-grade corporate bond market. So I'll stop there. I'll answer any questions if anybody has them, but otherwise I'll turn it back to Joe.
One of the things in that news article talked about the investors being extremely concentrated. We have data that will show you that the top 10 of this higher market, 10 investors own almost 30% of all the outstanding bonds. That is extremely concentrated. So so they have a lot of pricing power. So when you've heard comments like, say, well, we know who's been participating and who hasn't, and we'll ask whether, well, if you're selling to the same usual suspects, you're probably going to get the same usual price. What you need to do is expand the market, do more work. I can tell you as an investment banker, when I was there, it was like, let's move it along. Let's move it along. You know, having to make 10 calls for $5 million orders to get 50 million versus one call for a $50 million order, we'd much rather do the one call. The one call for $50 million order, he's at 505. Maybe I can get those other people who are buy and hold, who are more safety oriented, people who will be willing to accept lower yields for the safety. Other people, they're trying to get as much juice, what we call juice, yield as possible. And when you see the reports, fatter return, outsized, what do you think that means? I mean, it means that it's more than what really it ought to be. And our job is to work through inform you of that first, work and set up a structure in the pre-issuance review. Make sure the financing order is not restrictive to look at things. Because, for example, I did notice in one of the settlement, there was a sentence where Duke said, the QITP will be able to attend any meeting that the company makes to investors. And it was kind of, well, you kind of want to be where when the underwriter is making presentations to investors. I like to see that. And I normally did get to see that, be invited and participate. We can show you actually some film clips of where we did and had participation. We also, in Florida, we had a roadshow where we actually met with investors, with members of the commission staff. So you sort of look at that and it's like, well, okay, you may not be making all the presentations. All those other ones are being done by the underwriters. We don't know what's really being said. So we want to know what's being said, how it's being positioned, and get into that and create, I think someone called it creative tension or something like that. But that's where you have to, as President Reagan said, quoting a Russian proverb, trust but verified, cut the cards, build a deck, and be honest with what you see. And that's what we hold ourselves to. We're honest with what we'll see. We'll communicate it to you, and you can make the decision. You give it with our recommendation or ask us questions in public. And we're happy to be, we've given testimony on this in multiple jurisdictions. None of our testimony, I think, has ever survived cross. I don't think anybody has been able to impugn any of the data that we have. Maybe, I'm pretty sure. My memory hasn't failed me on that. But I think that gives you the comfort that you need. And not just this transaction, because there's going to be more down the road. And it's probably, the industry needs so much capital that this is going to go beyond storm recovery bonds. This is going to start, I mean, AEP already has done thing for rate base in West Virginia, and there's other talk about using this. And that's why we've got to make sure that the right precedents are set, because it's harder to overcome bad precedents. It's not impossible. We did it in Texas, and we did it in West Virginia and in Florida in 2016. But it's better if we think ahead, make sure we get the right precedents, the right basis, and we have a team here beyond me, and I appreciate my comments from my colleagues, but it really is a team effort. And you think you've seen that in our previous assignment, our detail, our thoroughness, that's what we bring. And we're willing to do it in writing, in the open, and really would be honored to have this opportunity to serve.
Thank you very much. Any further commissioner questions? Hearing none, gentlemen, thank you so much for being here, particularly being here in person, and thank you for your team that's here virtually, and hope you have safe travels back. We're going to make a decision, hopefully within a couple of weeks, and certainly everyone will know. Thank you very much.
And if there's any other written questions, we'll be happy to respond. Thanks.
We are adjourned.
Thank you.